The broadcast is now starting. All attendees are in listen-only mode.
All right, everybody. Thank you very much for being on today's webinar. We are going to try and do another 20-minute webinar. We know certainly that there is a lot of questions going on with regards to what's going on in the market volatility, and how we, and in general, advisors are positioning client portfolios. We know advisors are asking a lot of questions, given all the market volatility. With that, I have Dr. Charles Lieberman, Chief Investment Officer, Advisors Capital Management, with us. We're going to try and answer questions as well in real time. If you have them and you want to, I'm going to go ahead and turn off my camera now. Turn on my webcam. Okay. And I'm going to close that. Okay, so you want to go ahead and ask questions. We can answer them in real time. We'll try and answer them at the end. We'll try and answer them during this session. We understand your time is valuable, and so 20 minutes. Chuck, markets are volatile. Inflation is clearly a problem. You can see there on the right side of the screen, numbers, both CPI, PCE have exploded. Thoughts?
Well, that's why the Fed has committed itself to trying to get inflation out of the system. They've started raising interest rates. They don't want to shock the market. So they have telegraphed every step that they've taken well in advance. They've already told us they're going to raise rates again by another 50 basis points at each of the next two meetings, and probably follow those up with 25 basis point hikes also. So they've put us on notice that interest rates are going up. The economy's got to grow more slowly. They've got to get inflation under control.
And a lot of times that brings out fear of recession, right? We're having a lot of talks about recession. You've said we're not in the recessionary camp, first and foremost, because of where unemployment is. You know, if we were to go into a recession, this certainly would be unique in the fact that, right, this would be the first recession ever with unemployment in the threes. Is it likely, unlikely, impossible, possible?
Well, look, it's very simple. The Fed can hike rates too much, and they can hike rates too little. Both of those are possibilities. The Fed is committed to raising rates, to slowing down growth to contain inflation. So rates are going up. They need to get unemployment up a little bit. They've got to get the labor market less tight. It's the tightness of the labor market that is generating all of those wage pressures. We see large increases in wages pretty much now across the board. And if labor costs go up, labor is roughly 70% of the cost of producing GDP. There's no way to avoid inflation remaining pretty high. So they've got to get slower growth. They've got to get rates up in order to slow growth down. And could they push it too far? Sure. They could also push it not far enough. And so if, there's a happy medium in there, not too hot, not too cold, just right. And that's what they're trying to achieve. So I'm kind of surprised that people are running out and saying the Fed is going to blow it. There's a risk of that, and there's certainly a significant risk, but it's far from locked in as yet. And the chart on the graph shows you job openings. We're running about 11.5 million job openings. So there's a tremendous amount of pent-up demand for labor.
So we would want to see this number start to come down, though, right? Because if companies are concerned, if financial conditions are tightening, the first thing they should do, right, or you would expect them to do, would be to pull job openings. Yeah?
Exactly right. That's probably the single best or first place to look for definitive evidence of a slowdown. But, this number comes out with a delay. It's one of the last numbers we get on the U.S. job market. The number we got this morning, initial unemployment claims, that's one of the first ones you get. So that number has ticked up a little bit. We're a little bit north of 200,000. The low is about 180,000. Those are still very, very low numbers. And so the job market is still tight. It's premature to say, to say you've achieved what you set out to achieve, declare victory and call it a day. That is just absolutely premature. It's inappropriate.
So I have your housing starts, but perhaps I want to go to the next slide, which is more important here, and that's mortgage rates. So this is an example, right, of financial conditions tightening. right? The Fed wants to raise rates. They want to a degree, to increase unemployment. They want to slow growth. And in order to do that, right, they want to make it more expensive to borrow. Theoretically, right, that's the magic elixir that will start taking care of all of these things. Mortgage rates there on the right side clearly have started to move up. The housing market, from what I understand, is starting to slow down, starting to cool a little bit. Fed wants that?
Absolutely. It's just that the market has overreacted to the data. So we saw this week we got a new report on housing starts and housing permits. And there was a big deal made out of the fact that the permits level had dropped a little more sharply. The level of permits is still running above the level of starts. And the level of starts is still running at a very high level. And with regard to mortgage rates, that's how you cool the housing market down. That's one of the ways you cool it down. So you raise mortgage rates. But as this chart shows pretty clearly, you have a long ways to go before mortgage rates are really high. And by the way,
we're not far from where we were, like it looks like in 2018. I mean, it's
right. And at that point, mortgage rates were thought to be very, very low. Yeah. And so here we are, 2022. Mortgage rates have picked up a little bit, but the fact of the matter is, we had much higher mortgage rates years ago. And oh, by the way, inflation is much higher today, and therefore buying a house or an apartment or whatever is very attractive with current inflation and these mortgage rates.
All right, so we've got Powell, right? Jerome Powell, Fed chairman. In the past, right, the Fed clearly was responsive to market reactions based on what they had done. This time around, that doesn't seem to be as clear. The Fed has made it abundantly clear, right, that they are going to change, they're going to increase rates. This year on the screen, probabilities for the December 14th market. Where are rates right now? Do you know off the top of your head?
Yeah, well, we're at 280 on the 10-year Treasury. The 2-year is around 250. So we've still got rates at what I consider to be fairly low levels. There's a lot built in for Fed hikes, right? The market understands. The market has heard the Fed. The market knows multiple rate hikes are coming.
I'll tell you, where's Fed funds? Where's Fed funds?
Well, Fed funds are targeted by the Fed. They are set
right
between 75 and 100 basis points.
They've
only moved as much as policy rates have moved. The market is expecting Fed funds by the end of this year to be up in the ballpark of 2.5%.
That's what I was trying to get to. So right now, you got 100 basis points, 150 basis points of increases expected by the market from the Fed between now and the end of the year. The market, of course, is forward-looking. So you've had the equity market and the bond market both spill out and create, to a degree, a large scale of mess. You can see here on the screen, 45% of stocks in the NASDAQ are down 50% or more, 22% down 75%, and there are 5% of stocks down 90%. It's been a slaughtering. This is through 5/5. I actually have NVIDIA on here twice. I should have taken that out, but you can just see some numbers. These are not small companies, Chuck. These are big companies, right? And so a lot of advisors now are getting to the point where they're saying, well, what do we do, right? The bond market here down 20%, the long-dated bond market down 20% year to date, again through 5/5. Things are messy, to say the least.
But they had to become messy.
Okay.
So those big declines in those stocks that you showed, go back to that. Those things had extreme valuations. NVIDIA was trading at 50 times earnings, 50 times. Netflix, Microsoft was trading over 30 times earnings. Apple over 30 times. These are enormous companies. Can they grow enough to justify a multiple that high? It's really doubtful. And so as interest rates started to rise, the higher the multiple, the more value it's giving to earnings far down the road, and the more vulnerable the stock price.
Okay.
So that's why there's been this massive correction in high valuation stocks relative to value stocks. Value stocks are also down when they when something like this happens. They shoot them all, but High multiple stocks have really been devastated far, far more than value stocks, which have come down, but they were attractive before, and now they're really attractive.
Okay, so if you're an advisor and you know, right, you've got clients invested in whatever, some equity ETFs, some individual names, some bond ETFs, it's been messy across the board. A, what are you telling clients? B, are you putting money to work? So what's the first conversation? I know the conversation I'm having with advisors all day long. What are you saying? What's your sort of line to advisors who are saying should they be invested? Should their clients be invested at all?
Yeah, well, some of these stocks are still on the expensive side. Most of these stocks, most of these companies are great companies. You won't hear me say something negative about Disney, about Microsoft, about Apple, about NVIDIA.
I'm not talking about these specifically, though. I'm not talking about these specifically, right? I'm talking about the bigger picture.
Okay. The bigger picture is there's lots and lots of value in the market. If you ask me to construct a portfolio with the highest PE in the portfolio being 12, and it has to be a company that I like, that I think has good growth prospects, it would be easy for me to do. In the case of these high value stocks, there's more of a debate, and certainly if interest rates continue to rise, that's going to be a headwind for them. The value stocks have less of a headwind. On the fixed income side, you've got to keep your duration short. The value is there in short duration. You're now getting some decent yield in short duration paper. The longer term paper gives you incrementally not much more yield and incrementally vastly more risk. So stick to floating rate issues, short maturity issues. That's the place to be in fixed income. Let the Fed do its job. It's going to do it one way or another anyway. May as well get out of the way, not get hurt by rising rates, and stick to short maturities.
Now, here are market returns going back since 1928, and you can see we're already starting to flirt with that sort of outlier bottom territory there, right? 1931, the lowest number of depression, 2008, systemic. There aren't many that are largely in the territory for a year's total return that we're sitting in right now. What does that mean for the rest of the year? I mean, is this likely to get worse? Are we putting up an all-time historically bad number? Or does the market start to recover here? Maybe this isn't the end of the world. It's just a valuation reset and we can sort of move on from here.
I think it's a valuation reset. We should be moving on from here. I'm not going to call a bottom. That's very difficult to do. But I will say that anyone who goes out and spends a ton of money buying stocks today will be very happy a year or two down the road. These valuations are very, very attractive.
I'm going to ask you a harder question, Chuck. Why is it that, a day like yesterday, right, where the market's off 1,000, a day like today where the market's off a couple hundred, whatever it may be, it's not like we're getting new information. Interest rates are high. We know. The Fed is going to raise rates. We know. This should slow down growth. We know. Why is it that the market continues to a degree, right, vomit on itself with the same information over and over and over again?
Well, unfortunately, if you are in the brokerage business on the sell side, you need visibility. And one way to get visibility is to forecast doom and gloom. So we're hearing a ton of forecasts about recession, even though it's presumptuous to anticipate one in the visible future. I can't put together a scenario that justifies a recession in 2022. 2023 is further out. It's too early to call 2023. I have some concerns about 2023. The Fed could go too far. That's entirely possible. But right now, the valuations are attractive. And just on the basis of being down around 20%, this strikes me as a buying opportunity from a macro perspective. And then from a micro perspective, at the level of each individual company, I find so many that offer great value that I'm not worried about buying stocks at current valuations. I think there are a lot of opportunities. So if you look for companies that benefit from higher inflation, companies that benefit from higher interest rates, companies that are selling at cheap valuations, put that stuff together and you'll end up with a great portfolio.
It's funny. A lot of people say, I've heard this feels a little bit like 1987. One worth mentioning on your screen that 1987 finished the year positive. And for anyone who says that, I can't possibly believe that they remember what it feels like a market felt like 40 some odd years ago, 35 years ago. I find that nonsensical. Okay. Earnings going up. All right. So let's go to the slide here. Corporate earnings are going up. You say the Fed could go too far. There's a lot of concern that the Fed could break something. Me and you were talking about this earlier. I'm not sure I believe they get to as many hikes as they want because the damage is large to me at this point, at least on the equity side. And we have 3 minutes to go. Worth talking about this. You obviously the PhD in economics. You have all the history studying this stuff, right? And the way markets work is probably why I'll be right. This is the way they work. But you have unemployment claims going up. You have financial conditions tightening. To me, you should have some sort of demand, and I'm just sort of talking about demand destruction, right, resulting from people spending less, right? Maybe putting $20 in the gas tank as opposed to filling it. Maybe, spending less, going out less because their portfolios are being blown up left and right. Does that start, if you demand destruction, put a release valve, release some of the pressure on the supply chain, maybe bring pricing down there. The Fed doesn't have to go as crazy as they did. And that in and of itself, or the Fed doesn't have to increase as many times as they have said, or the market thinks they do. And that could be viewed as bullish for equity markets. Thoughts?
So again, it's a matter of degree. The Fed needs demand destruction. If the Fed were to get no demand destruction and the economy were to keep on growing on its current track, that means that we're generating 400, 500,000 jobs per month. There aren't enough unemployed people in the United States to meet that kind of demand for more than half a dozen months mathematically at the outside. We are going to see a slowdown in job growth. It is mathematically certain. And therefore, we are going to get a slowdown in economic growth. That needs that. And it needs to see that filter out into prices. We need to see a slowdown in wage growth and a slowdown in price growth. And some of that is happening anyway, regardless of what the Fed does, because the supply chains are slowly being repaired. So some prices are going to come down. The problem is the economy still has a lot of momentum and needs to slow down soon. And so it's got to happen. And I'm sure the market will get carried away to the upside in response to that. As long as something doesn't break, as long as something doesn't break, the markets will love the slowdown.
And I see some companies are starting to lay people off, freeze hiring. Uber, Netflix, Facebook, they Wells Fargo in the mortgage department. So you do have some activity taking place there. It may not be a lot. It may not be widespread yet, but certainly there is some activity that companies are pausing, right? Good, correct?
Yeah, so keep an eye on initial unemployment claims. They come out every week on Thursdays. The level did tick up a little bit this week, and I expect some more upticks in coming weeks. But let's look to see order of magnitude. If it goes from 220 to 260, 280, I wouldn't be disturbed. It needs to go above 300 before I'll really think that there's a risk that the Fed has overdone it. And then we'll get more employment reports, which will show us how many jobs are being created.
In the last minute we have here, are you expecting more volatility? Are you telling advisors, hold your nose, put client money to work, dollar cost average in, understand what you own? That's what we do, right? We build individual portfolios. If you want us to look at your client portfolios, you want us to look at any prospect portfolios, give you some talking points, how we're doing, what we're doing, why we're doing anything, you can see there. I want to learn more at advisorscenter.com. That's our phone number there on the screen. Call us. We're happy to help. Obviously, we are available on all of your broker-dealer platforms. Chuck, final thoughts here. We want to keep it to 20 minutes.
Yep.
Do you expect volatility to continue?
The market is going to remain volatile. You're never going to catch the bottom. But you can look at the market, and it's easy to see that there are lots and lots of values. And that's why I say if you have money to invest, it's a great time. You're not going to necessarily avoid any further declines, but if you put money to work and give it some time, 6 months, a year, 2 years, you'll be very happy with the result.
With that, if anybody has any questions, feel free to type them into the chat box. Otherwise, we have taken 20 minutes of your time, which is the exact amount of time we wanted to take. We thank you all for being on today's call. Again, our contact information is on the screen. Chuck, as always, thank you. Insightful. Hopefully this is closer to the end than it is the beginning. With that, everyone, have a great rest of your afternoon. Thanks, everybody.